Starting investing can be scary, I feel you. And part of the reason we're scared is we believe some common misconceptions about investing that in reality are false. They are a myth, and research actually proves them wrong. So today, let me uncover 5 investing myths and what the truth behind them is. By the way, if you're new, my name is Rebecca and welcome to my channel where it's about making your finances and your life more simple. And if investing is a topic you're interested in, I have an entire playlist that I will link down in the description box, so you can check it out after this video if you want to. But for now, let's get started with the first myth. You need a lot of money to invest. Really? So investing is only for the rich? I don't think so, and the numbers that I'm going to show you will prove the statement wrong. Let's assume you only have a monthly $200 to invest and you start at 25. At the age of 65, that will give you around $479,000, which is more than triple of what the average American has saved up for their retirement. So even small amounts will add up over time, especially if you invest that money and get the higher interest rate of the stock market instead of just saving it on your bank account and getting the savings rate there. And what that simple calculation did not take into account is that there will definitely be years or even decades where you make more money and you could invest more than those $200. So that means at the end you'll have much more money. Next myth, investing your money in the stock market is riskier than keeping that money in a savings account or having it in cash. If you're thinking short term, that statement is true. If you keep your money in the stock market for just one day and then take it out, the chances of you making money are 52.4%. So that's about the same odds as just tossing a coin. However, if you keep your money invested for a year, your odds will increase to 65.6%. And the longer you wait, the safer the bet. Past data shows that there has never been a time in history where you would have put your money in the stock market and lost that money or made a loss if you had waited for 15 years or longer. And the average return on that investment, 7% per year. That means as long as you see your investments as a long-term thing, you don't have to worry. Research shows that over a long period of time and with a diversified investment portfolio, your money is as safe on the stock market as it is in your bank account, only that on the stock market you're making much more interest. Next up, when the stock market goes down, you should pull out your money. That is very false. Please don't ever do that. Let's say you invest $1,000 in one particular stock, and let's say that 2 weeks later that stock is now only worth $800. Should you now take out your money? No, because if you do, then you will actually have lost those $200. But if you keep your money invested, chances are the stock will recover and then maybe in a year it's worth $1,300. So if you wait and did not sell it at $800, you have actually not lost any money. And if you decide to sell it at the $1,300, then yes, you have made $300 in gains. Remember, the current market price is just a reflection of what that stock or fund is currently worth, but you haven't lost or gained any money yet. Only when you sell it, you're accepting that price. So again, long-term thinking. If you invest in your stocks and funds long-term, you will make money over time. Of course, there will be some seasons where the stock market is down and you will get scared. So what? Just sit it out and wait. Don't check your portfolio too regularly and freak out. I mean, if you're invested for the long term, why should you even bother what today's price is? You will not sell your investments for another decade or even longer, so don't worry. Next myth, you can time the market. What does timing the market actually mean? Well, it means that you want to buy stocks or buy funds when they're at a very low price, and then you want to sell them when they're at a high price. The problem with that, well, you don't know what's going to happen tomorrow. You don't know what the stock price will be tomorrow. So you might think, wow, it's a very, very cheap price right now. Let me go in and buy. And then the next day it falls another $20. So that means you could have bought it much cheaper the next day. You just never know. Research shows over and over again that timing the market is extremely difficult, and it means that if you sell your investments, you could be missing out on one of the best days of the stock market that year. You just never know what days of that year are going to be the days with the most growth. So if you're missing out on one of these days, you will actually make much less money than somebody who had just stayed invested over the entire year. For example, a study of Fidelity shows that if you had invested $10,000 in the S&P 500 over a period of 10,000 trading days, your gain would have been $1,082,000 if you had stayed invested all of these days. But if in these 10,000 days you would have missed on the 10 best days of this period, your gain would have only been $483,000. So as the British fund manager Terry Smith said, there are only two types of people, those who cannot time the market and those who don't know they cannot time the market. The last statement I want to talk about is you should pay off all your debt before you start investing. And that's a tricky one because financial experts don't all agree on that. But let's start with the thing that they do all agree on, and that is if you have high interest debt, you should definitely pay that off first before you start investing. But what is high interest debt? Usually that's any interest rate that is much higher than what you could make on the stock market. So that's 7 to 8% of the stock market. So if you have credit card debt or anything that's like 10, 20, 25%, you should definitely be paying that off first and then think about investing. But anything that's low interest debt, you can definitely consider starting investing first before you have paid it off and only make minimum payments. So the statement that you have to pay all your debt off regardless before you start investing, that's a myth. Let's say you have a 2% loan and you could either make only minimum payments on the 2% and invest the rest of your money in an ETF, for example, or you could pay off the entire loan before you start investing. From a purely mathematical point of view, it would make much more sense to invest the rest of your money and only make minimum payments because you will make more money on the stock market than you have to pay on interest. Because the money that you're investing will make about 7 or 8% in the stock market over the long run, minus the 2% that you're still paying on the loan because you haven't paid it off yet. That's still 5% of positive return. However, it is a very personal choice. If you're someone who's very stressed out about your debt and you just want to get it over with and you can't deal with it any longer, then by all means pay off your debt as fast as possible and then start investing later. Your mental health and your well-being is much more important than making that extra money. But if you don't have such strong feelings and if you would like to make a little extra, then definitely consider option A. So that concludes this video. If you have any further questions about investing or any topics you want me to make a video about, then please let me know in the comments. I do read all of my comments and I'm always happy to hear suggestions. I really hope this video was helpful and took away a little bit of your overwhelm when it comes to investing. You can check out the investing playlist next. Thank you so much for watching. Have a great rest of your weekend. I will see you in my next video.